Hi guys, welcome to my channel. Today we're delving into one of the most prominent indices in the world of finance, the S&P 500. Picture this. You're navigating through the vast landscape of the stock market, searching for the beacon that illuminates the path to financial success. Amidst the sea of numbers and charts, one name stands out, the S&P 500. But what exactly is this powerhouse index, and why does it hold such sway over the world of finance? Join us as we unravel the mysteries of the S&P 500, the heartbeat of the stock market, and discover how it shapes the fortunes of investors worldwide. The S&P 500, short for the Standard & Poor's 500, is a market capitalization-weighted index that tracks the performance of 500 of the largest publicly traded companies in the United States. These companies represent a diverse range of sectors and industries, including technology, healthcare, finance, and consumer goods. Let's explore the top 10 companies by index weight. Number 1 is Apple Inc. Number 2 is Microsoft Corporation. Number 3 is Amazon.com Inc. Number 4 is Alphabet Inc. Number 5 is Facebook Inc. Number 6 is Tesla Inc. Number 7 is Meta Platforms Inc., formerly Facebook. Number 8 is Nvidia Corporation. Number 9 is Johnson & Johnson. Number 10 is Procter & Gamble Co. Now you might wonder, why 500 companies specifically? Well, the S&P 500 aims to provide a comprehensive snapshot of the U.S. stock market by including companies from various sectors. This diversification helps reduce risk and provides investors with a broad gauge of market performance. One of the key features of the S&P 500 is its role as a benchmark for the overall health of the U.S. stock market. Many investors and financial professionals use the index as a barometer to gauge the performance of their portfolios and to compare against other investments. But how exactly is the S&P 500 calculated? Well, it's based on the market capitalization of its constituent companies. Market capitalization is determined by multiplying the company's stock price by the total number of outstanding shares. This means that larger companies have a greater impact on the index's performance. Now, you might be wondering, what are some of the criteria for a company to be included in the S&P 500? Well, there are several factors, including market capitalization, liquidity, and financial viability. The index is periodically reviewed and adjusted to ensure that it accurately reflects the changing landscape of the U.S. stock market. Another important aspect of the S&P 500 is its impact on investment strategies and financial products. Many mutual funds and exchange-traded funds, ETFs, are designed to track the performance of the index, allowing investors to gain exposure to a diversified portfolio of U.S. stocks with relative ease. So, why does the S&P 500 matter to you as an investor? Well, for starters, it provides a valuable benchmark for evaluating the performance of your investments. By comparing your portfolio's returns to those of the S&P 500, you can assess whether you're outperforming or underperforming the broader market. Additionally, the S&P 500 serves as a reflection of the overall state of the U.S. economy. Changes in the index can signal shifts in investor sentiment, economic growth, and corporate earnings, all of which can have significant implications for financial markets worldwide. Investing in the S&P 500 through index funds or ETFs is a form of passive investing. This means you don't need to actively manage your investments, which can be a more hands-off approach for investors who prefer a set-it-and-forget-it strategy. Investing in the S&P 500 is typically more suitable for long-term investors who can ride out market fluctuations and benefit from compounding returns over time. While the S&P 500 provides exposure to a diversified basket of stocks, it's important to consider whether your portfolio should include other asset classes such as bonds, real estate, or international equities to further diversify and manage risk. Many index funds and exchange-traded funds, ETFs, that track the S&P 500 have low expense ratios, making them a cost-effective way to invest in the stock market. Ultimately, investing in the S&P 500 can be a good option for many investors, especially those seeking long-term growth and exposure to the U.S. stock market. Over the years, the S&P 500 has demonstrated resilience, weathering economic storms, and delivering long-term returns that have outpaced inflation. For investors seeking simplicity and diversification, investing in the S&P 500 through index funds or ETFs offers an accessible and cost-effective avenue. Its passive nature allows individuals to participate in the growth of the market without the need for constant monitoring or active management. However, while the S&P 500 has historically delivered strong returns, It's essential to acknowledge the inherent risks associated with investing in the stock market. Market volatility, economic downturns, and geopolitical uncertainties can all impact the index's performance. Therefore, before diving into S&P 500 investments or any financial endeavors, it's crucial to conduct thorough research, assess your risk tolerance, and develop a well-defined investment strategy aligned with your long-term goals. As you embark on your investment journey, remember that knowledge is power. Stay informed about market trends, economic indicators, and emerging opportunities. Consider diversifying your portfolio across different asset classes to mitigate risk and maximize returns. And most importantly, remember that investing is a journey, not a sprint. Be patient, stay disciplined, and focus on the long-term growth of your investments. If you found this video informative and insightful, don't forget to like, subscribe, and share it with your friends and fellow investors. By spreading knowledge and empowering others, we can all strive towards financial literacy and success together. Thank you for joining us on this exploration of the S&P 500. See you in the next video.